Greetings, everybody, and welcome to the first All Facts Matter podcast, where we push back against corporate media propaganda with facts, evidence, and data. I am Peter, author behind All Facts Matter, so let's begin. This presentation is something of an experiment to find out if this is a better way for people to absorb the data contained in the many charts and graphs that adorn my Substack articles. My goal is to provide a bit of explanation into how these charts and graphs drive my analyses of various economic issues. And with luck, the data will be a little more accessible to everyone. Longtime readers are no doubt aware of my recent predictions that consumer price inflation is in the process of heating up once more. Longtime readers are also aware that I bolster my predictions with a series of observations drawn from various publicly available data sets. Yet that should not be taken to imply that all the indicators are pointing to inflation. They aren't. There are more than a few economic indicators which suggest that the U.S. could be headed into a period of protracted consumer price deflation rather than inflation. It would be folly to ignore the presence of these contrarian indicators, as they may prove to be the most accurate. Excluding the contrarian view is part of how corporate media managed to destroy its own credibility. As I choose to be honestly wrong rather than deceptively right, let's explore the possible indicators of coming deflation in the U.S. economy. First, let's revisit the consumer price inflation narrative. As I have said before, at the core level especially, consumer price inflation is heating up. As we can see, the month-on-month inflation rate has risen steadily from June to July to August to September, and soon we will be having the October numbers come out, and we will see where that is as well. A primary driver of this rising core inflation has been service price inflation, which, as we again see, has been warming up from June to July to August to September. But more importantly, with service price inflation, we should note that we're really just getting back to what has been the normal inflation rate for services throughout the entire year. Inflation for services is not so much heating up as it is staying at a constant elevated level. And much of what this means is that much of the disinflation that we've been seeing is the result of various deflationary forces pushing down prices, offsetting this upward price pressure, this inflationary pressure that has been a constant in services all along. In September, the likelihood of coming inflation was bolstered by the fact that commodity prices, broadly speaking, rose. They bottomed out around September the 10th, and then they began rising throughout the remainder of the month. Commodities, of course, are the raw materials that go into most manufacturing processes, and these prices are essentially the costs for those inputs. If these costs are rising, then consumer prices on the other end are also going to be rising. And so this upward trend is definitely an inflationary pressure. Most significantly, we saw that in September, oil prices, again, bottomed out, much like commodity prices, around September the 10th, and then began trending upward throughout the remainder of the month. The key difference is that oil prices did not rise above their September 1 levels, which was how in September we still managed to see energy price deflation for the month. But clearly, the amount of energy price deflation we might have seen was reduced by the fact that for the middle part of the month, we saw significant price increases from this bottoming out floor price. And this is where we have to start considering the possibility that deflation rather than inflation may be the future of the U.S. economy. As I have stated many times before, as long as this upward price trend continued, we could expect energy price inflation. And if we were seeing energy price inflation, an end to the energy price deflation, which we had been seeing, meant that we would not have this offsetting service price inflation, but rather adding to it. And so we would see a much higher level of inflation overall than we have been seeing. However, that trend stopped on October 7th. After October 7th, we see energy prices trending down again. And as of this podcast, they are below where they were at the start of September, which means we're still potentially looking at energy price deflation. And if these prices drop much further, we're definitely looking at energy price deflation for October. And even more intriguingly, we may actually push below the floor price that was established in early September. If we push below this, we could be looking at a protracted period of energy price deflation, and that would have significant impacts on inflation overall within the economy. What makes that floor price from September significant is this has been the floor price, approximately, that has been established since late 2022. As we can see, this has about been where oil prices have gotten down to, and once they hit that level, they trend back up a little bit. And will pretty much start to move more or less horizontally. And what we saw in 2022 through mid-2023 was energy prices were moving more or less horizontally. And then they began trending up again until early April of 2024. From that point forward, they've begun to head down. And while it seemed like they may be reversing that trend again, what's happened in October is we're falling back down once more. And we're getting closer and closer to this long-term floor price. And the question is going to be, are we looking at a deflationary trend in energy that's going to push through this floor? If oil prices push below this, we're definitely looking at some significant energy price deflation going forward. It will be interesting to see how far oil prices go below that. But as long as this keeps decreasing, we're likely to see continued disinflation at the headline consumer price level for quite some time. In fact, this may actually make my initial prediction of that we would be seeing rising consumer price inflation wrong. This right here could be sufficient to upend that prediction. The important thing to note about the commodities prices is that they've also followed the same basic trend. They peaked at about the same time, and they've been going down about the same amount. They're still, because they rose higher and further above the September 1 level, they're still above that, but they've come down significantly, and the indications are that they're going to continue to do so. If they do, then again, we're looking at commodity price deflation, which is going to lower the cost of inputs for various manufacturing processes, and that's going to lower prices overall. So just as this was an inflationary pressure in September, in October, we have a deflationary pressure coming from commodities. This is worth noting because several uh, economic pundits on various news channels like Fox News and others have stated that commodity prices are going up. They were going up, but when we look at them now, they're going down. This changes whether we're looking at future inflation versus future deflation. As of the latest trend, commodity prices are saying our future is disinflation or deflation. And when we look at the longer term for commodities prices, we see that once again they're following the same basic pattern as the oil prices have. They were a little bit later in establishing a floor level, but we're still getting back down close to that floor level, and we may be seeing them pushing below that. And if they push below that floor level, then we could very easily be seeing an extended period of commodity price deflation, and that would have significant impacts on consumer prices, and we'd be looking at potentially consumer price deflation going forward. So between oil prices and commodity prices, we're looking at a forecast that says we're not looking at the very minimum, we're not looking at as much inflation as we were, and we may be looking at even less than we have had in the past. It could, will it turn into outright deflation? Depends on the magnitude of the effects, but that's not impossible. This was the other graph that made me realize that deflation deserves some attention, because when the last producer price index came out, intermediate demand had been printing deflation for the past 2 months. The producer price index, which is also, you'll also see me refer to it as factory gate inflation or factory gate prices, are the prices that are basically charged by producers as their goods, services leave their production facilities and move out into the larger economy. Think of it as producer prices are what vendors are offering their goods for, consumer prices are what they actually pay. Because of this concept of factory gate pricing, the broad assumption is always that the producer price index is a leading indicator of what's going to come about in the consumer price index a few months down the road. So if we're seeing deflation in the producer price index in August and September, we could be looking at a strong deflationary impulse in possibly November, possibly December, and almost certainly in January. And if this trend continues, then we're looking at an even stronger deflationary impulse. Now, this kind of also ties into the commodity pricing, because these are the price indices for intermediate demand. These are for the goods that go to other manufacturers to be turned into other goods. So what we're seeing is a reduction in the costs of inputs at each stage of production. And again, reduction in cost is going to be a downward pressure on prices for consumers. And we've seen this now happening in August. It happened again in September. It will be interesting to see what the October numbers look like, which will be coming out in a few weeks. And if the intermediate demand indices show deflation yet again, then we're looking at a significant deflationary impulse heading into the economy a month or two down the road. The other reason to be taking intermediate demand deflation seriously is Once again, we're seeing that the prices peaked in mid-2022, and this time frame, remember, is when consumer price inflation also reached its peak. Right here around June of 2022 is when we had the 9% consumer price inflation threshold reached. We're seeing that even in intermediate demand, those inflationary pressures peaked at about that time, and this being the raw index, these price levels have been broadly decreasing ever since. So we've had intermediate price deflation, intermediate demand price deflation, since roughly June of 2022. So we've got a sustained deflationary pulse taking place coming from goods that are going to be used elsewhere in the manufacturing process to be turned into other goods. This doesn't mean that there will be no price increases, but this is definitely a pressure to hold prices down, push prices down, and it's clearly that's why I call it a downward price pressure. Another potential leading indicator is that final demand, and this is basically the goods that are leaving the loading dock, heading out to stores, heading out to warehouses, etc. That producer pricing for final demand was in outright deflation in September, which means that the prices that were being charged by producers of various goods and services fell by roughly a tenth and a half percent in the month of September. Whether that'll be repeated in October, of course, remains to be seen. If it does, we're definitely looking at a significant downward price pressure over time. That's going to, that is going to work directly counter to service price inflation, which is tending to push prices back up again. And again, we can see that while final demand has not gone into outright deflation over an extended period of time, we have seen, and again, note that this inflection point comes right where consumer price inflation peaked in June of 2022, but prices largely plateaued and didn't increase a whole heck of a lot from June of 2022 through the end of 2023. And in the first part of this year, factory gate pricing rose again up until about midsummer and has actually started to trend down again. So we were seeing a minimal amount of upward price pressure coming in the early part of this year, but that's ended. So again, we're seeing this. Remember, this is a leading indicator. So if this is starting to trend down, then we're looking at something that a few months from now is going to be translating into lower consumer prices. So this is another leading indicator saying, okay, we're looking at deflation, disinflation coming into the U.S. economy in the future. Now, it's not just pricing that tells us that we could be looking at some deflationary scenarios. Perhaps the most glaring deflationary signal that we've got has been that we're looking at declining manufacturing. As we can see from the measures of industrial production for manufacturing goods, across the board, we're seeing, in the case of manufacturing for that falls outside the category of durable and non-durable manufacturing, we're seeing some significant pricing declines. But we're also seeing a shallower decline for non-durable goods and for durable goods. Durable goods peaked later in 2022, but production has been declining. This is actual deflation itself. This is we are producing less and less of whatever widgets. This is economic contraction by definition. So if we're seeing a reduction in output, we definitely should be anticipating some downward pressures in prices, because obviously there's just not a lot of interest in manufactured goods. Notably, the only industrial production sector that is showing significant growth has been defense contracting. Yeah, starting in summer of 2022, uh, industrial production for defense goods has been going up and up and up. This is almost certainly attributable to the war in Ukraine. This has been one of the consequences of the funding that has been going to Ukraine. And while the funding for Ukraine is debatable on several levels, one thing we should note is that that funding has been driving defense production, and that's an expansion in the economy. That's a growth in the economy. It does tend to be somewhat inflationary, but it's also pushing against some of the other deflationary forces that we're seeing. Does that make the spending in Ukraine good? No, that's a question of policy. What we note here is simply this is one of the consequences of that spending. And if that spending should ever fall off, this increase in defense production will likely also taper off. And so there is an economic consequence to that, should that be the decision reached in the next administration. A way that we know that manufacturing is very much heading into a decline is the fact that over the period of the Biden-Harris administration, manufacturing hours per week have fallen significantly. We're about a half hour on average per week less across all manufacturing employees in the United States. While a half hour may not sound like much, for an average, that's a significant decline. And it's far more than we would want to say. And in fact, we would want to be seeing a growth in this number, seeing it heading up, because the more that people are working in manufacturing, that means the more that there is demand for manufactured goods. That means there's more manufacturing taking place, and you're looking at a general increase in the manufacturing sector of the economy. So this going down means we've got fewer people working in manufacturing. They're working less, which means they're earning less, and so they have fewer dollars to pump into the economy as consumers, which is translated into, this is another deflationary impulse that's getting transmitted into the economy. Compounding that is the fact that manufacturing employee growth has really not been as good as Joe Biden and Kamala Harris have laid it out to be. They want to be bragging about all the manufacturing jobs they've added, and they're starting from here, the beginning of 2021. But what they're overlooking is that the majority of the jobs that were added in 2021 and 2022 simply were to get the United States back to where it was at the start of the pandemic panic in early 2020. So the number of net new manufacturing jobs that have actually been added, that this administration we currently have can plausibly take credit for, is really maybe at best about 200,000. But even at that, it's fallen off significantly over the last few months. That the manufacturing employment actually peaked sometime in about October, November of 2023, and it's been slightly trending down, not steeply, but it has been trending down ever since. So we're looking at a loss in manufacturing jobs over the course of this past year. Just as with declining hours, if we have fewer people working in manufacturing, that's less output, that's less wages being earned by people in manufacturing, that's fewer dollars being circulated into the economy. Um, and so again, we're looking at a deflationary impulse. We're also looking at a contractionary impulse. These are signs of an economy that's actually contracting, getting smaller. You've got people working less, and you've got fewer people working in a sector. That means that the manufacturing sector is in decline. It is contracting. You know, there is less manufacturing going on to contribute to uh, prices, but also to economic growth. Yeah, and it, these are some of the forces that we're looking at. Now, are these indicators which are flashing deflation going to be more influential and more dispositive than the indicators which are flashing inflation? Possibly. We don't really know. And that's why we want to take a look at them, because we need to be aware of these forces that are pushing against inflation. They may prove to be more significant. We don't know. It is also possible that we could end up with the intensifying of trend that I've described before, where we have inflation within some goods and some services, and we have deflation in the form of reduced industrial output and across other goods and services. That we have a combination of inflation and deflation, and broadly speaking, that kind of amounts to a stagnating economy, or stagflation. One way to look at stagflation is that when you have inflation and deflation taking place pretty much at the same time. It's the definition for stagflation that I actually focus on using, um, which is a little bit different from what most economists use, but I think it is more illustrative of what's actually taking place in the economy, where you have some prices are going up, other prices are going down, and what's happening is you're getting a greater and greater distortion of prices within the economy, and that's detrimental to everybody. Now, we can. It's problematic whether you would consider stagflation to be less dire than outright deflation across the board. A lot of that depends on someone's particular perspective. Um, if you're purely a consumer, falling prices are a godsend to you, because that means you're spending less for what you want to buy. If you're a producer, falling prices is not good, because that means you're able to charge less, you're making less money, and you may already have some fixed costs which uh, aren't coming down, and this is therefore starting to eat into your profits and can create some problems for you there. Inflation, by the same token, can be good for can be, on the short-term basis, be good for some businesses, because they can charge more, uh, while at the same time taking advantage of previously lower input costs. Um, but again, the challenge here is that you're looking at a distortion where you've got essentially phony costs and phony profits being injected into the mix. Yeah. One thing we should note is we've seen what extended deflation can do in an economy. We saw that the United States economy saw that in the 1930s with the Great Depression. Um, we got a hint of what that might be uh, when uh, when the subprime mortgage crisis in 2006-2007 metastasized into the Great Financial Crisis in 2008. And some of the arguably subpar economic performance that we saw in the years after that amounted to essentially another lost decade. The United States has actually had a few lost decades of subpar economic growth or no economic growth, much like what countries like Japan and now China are experiencing. Does this mean that do these two factors mean that we're going to see deflation starting in October? Possibly not. But we shouldn't be blind to the possibility that we could be seeing inflation ending in October, and then in November we start to see accelerated disinflation and perhaps even outright deflation. It's possible. And the longer that some of these deflationary indicators press forward, the more likely that outcome starts to become, which is why we want to, another reason why we want to take a look at it. In the short term, I do expect inflation to keep rising. The core prices are definitely, I think, are going to continue to rise. Service prices are showing no sign of really abating. How much energy price deflation we're going to see in October is somewhat problematic. I don't think we're going to see much. And if we see reduced energy price deflation, we're definitely going to see uh, overall inflation levels at the consumer price inflation levels going considerably hotter. So I do see uh, inflation heating up at least a little bit in October. Over the longer term, I will not be surprised if prices meet, begin to level out again, and we start seeing more consumer price disinflation. We might even start seeing some consumer price deflation at some point. Again, a lot depends on how far some of these trends go, but the longer that these deflationary indicators press forward, the more likely it is that at some point we are going to be seeing significant disinflation and possibly even a little bit of outright deflation. That'll be something that we just have to that people just simply have to keep an eye on the indices and on the trends and see what's actually taking place. What is certain is that whether we're looking at inflation, deflation, or some combination of both, none of these scenarios are good for the economy. Inflation, as we all know, takes a bite out of people's paychecks. Deflation can take a bite out of company profits, which can hurt employment and a variety of other things. Stagflation, where we have both inflation and deflation taking place at the same time, distorts price levels and makes making consumer choices even more challenging. And this ultimately is a net reduction in overall purchasing power, because the amount we can spend on an individual, suddenly the price levels are shifting. That they're becoming some goods are becoming more expensive relative to others. Yeah. So none of these scenarios are exactly good. This isn't it could be good or it could be bad. What these scenarios that we're looking at are all variations of how bad is the economy actually going to get and how bad is the economy right now. Yeah. Will we have inflation, deflation, or both? It's hard to tell, and it's always going to be hard to tell. We very likely could have first the one, then the other, and in the end we will wind up with both. That might actually prove to be the most probable scenario. If that is the most probable scenario, that's not a good thing. If inflation ends up being the outcome, that's also not a good thing. If deflation is the outcome, that too is not a good thing. So even if I end up being wrong on inflation, that we're in fact looking at stagflation or deflation, none of these are cause for optimism or cause for celebration about the state of the economy. When corporate media says that the economy is doing well, none of these scenarios show that the economy is doing well. None of these indicators are showing actual, reliable, sustainable economic growth. And that is perhaps the most important thing to take away from all of this, is that all of these indicators are pointing to something bad. None of these are pointing to anything good. And if you've liked this podcast, if you find this type of presentation interesting, please like this and drop me a note in the comments to let me know that this is something you want to see and hear more of, and I'll be happy to do them. Um, and please also, if you do enjoy my work, please making a donation to a one-time donation or signing up as a paid subscriber. All of the all of these contributions definitely help keep this work going, and I greatly appreciate all of your support. But definitely let me know if you like this type of presentation so that I can do more of it. And we shall see. We shall see what happens. And I thank you for your time, and have a good day.